Hello everyone, I'm Joyce Chang, Global Head of Research, and I'm delighted to be here today with Marko Kolanovic, our Global Head of Quantitative and Derivatives Strategy. And we're here to talk about the mid-year 2017 markets outlook. Well, what a start to the year we've had. Strong performance across all asset classes, but almost all signs of reflation are reversing. We've seen long-term expectations for inflation come down, although the economic prints have come out as we expected, nominal GDP growth in the first quarter at about 6.1%. But we've seen much lower yields than what we had been anticipating at the beginning of the year. So what lies ahead for the second half of the year? Marko, I'd like to start by asking you to talk about the equity markets. We've had almost double-digit returns since the beginning of the year. Can this continue, and what's driving the equity market performance?
Thank you, Joyce. We are cautiously optimistic for the outlook for equities. If you look at the last earnings season, it was pretty strong. Our forecast for the earnings this year for S&P 500 is $130. So we think that the current level of equities are fully justified, valuations which are fully justified. If we could have a fiscal reforms, namely if we can have a cut in a corporate tax rate, we think that market could actually take another leg higher.
The volatility has been so low. We're close to historic low levels for vol. Can this continue, or could there be a spike that really derails the story that has played out since the beginning of the year that's been remarkably stable?
Yes, volatility is indeed at historical low levels, and we don't think it's fully justified. If you look at the current level of VIX is about 10. That's just about half of the historical average. We think that in part, why volatility is so low is because of the supply of yield-generating strategies into the market. In addition to supply of volatility to the market, we see very low macro correlations as well as inflow into passive and quant strategies, which are also suppressing volatility. So we do think there is a risk that volatility can quickly actually spike, and we think investors should position their portfolios accordingly.
So a little caution here going into the second half of the year, but still very strong earnings that are sort of at multi-year highs that make this still a reason to stay invested for the most part going into the second half.
That is correct, and we are closely watching sort of geopolitical developments, which are also posing some risk. Joyce, given the sort of risk that we have in geopolitical environment, what is your outlook for global fixed income and global emerging markets?
Well, the year had started with a lot of fears about emerging markets, that we would see protectionist measures, that we would see a lot of anti-trade measures, and that hasn't played out. And what we've actually seen is that emerging markets equities and also fixed incomes have been leading, partly because of the high yields and partly because investors were so underweight in these markets over the last few years. We still are overweight on emerging markets equities, and we're overweight on the emerging markets local currency, which have a yield that's more than 6%. Now, one of the big surprises this year was the record inflows that we've seen into bonds. We're on track now to hit about $800 billion of inflows into bond markets, the second highest ever on record. And this is still an environment where we think that income matters and that positive carry will remain attractive, but we think there will be more modest spread tightening given the moves we've had since the beginning of the year. Well, thank you so much, everyone, for joining us today. And we hope that you will follow the Global Research team on social media and reach out to us to hear our views for the second half of the year and beyond. Thank you so much.